Silver has entered a moment that few market participants anticipated with such speed. In a single trading session, the metal surged to a new all-time high, touching $86.25 per ounce and rewriting long-standing price ceilings that had defined the market for years. This was not a marginal breakout or a technical anomaly. It was a decisive move that immediately altered how silver is perceived within the global financial system. Prices did not drift upward gradually or respond to a single isolated catalyst. Instead, the market delivered a sharp and forceful repricing that placed silver firmly at the center of attention across the precious metals complex. Even after pulling back slightly from its peak, silver remained near the $85 level, reflecting sustained strength rather than a fleeting spike. The magnitude of the move signaled that deeper forces were at work, forces capable of overwhelming short-term resistance and accelerating price discovery. In this context, silver's surge stood not as an isolated event, but as a defining moment that forced investors, institutions, and analysts to reassess assumptions that had governed the metal's valuation for decades. The speed, scale, and persistence of the move transformed what had been a niche discussion into a broader financial event with systemic implications. The intraday behavior of silver underscored the intensity of the market's response. Prices surged rapidly to the 86.25 level before experiencing a modest pullback, yet this retracement did little to diminish the overall impact of the move. By the end of the session, silver remained near $85, still registering a gain of more than 6% in a single day. Such a percentage increase is significant for any asset, but particularly so for a market as mature and globally traded as silver. The pullback itself did not reflect a loss of conviction, but rather the natural response of a market adjusting to sudden repricing. Volatility expanded as buyers and sellers recalibrated positions in real time. Despite this, the ability of silver to hold near its highs suggested that demand remained firmly in control. The day's price action illustrated a market transitioning from incremental movement to accelerated momentum. Rather than reversing sharply, silver consolidated near elevated levels, reinforcing the perception that the move was not merely speculative noise. The intraday structure revealed both heightened emotion and structural demand, creating a dynamic where volatility increased, but direction remained intact. This balance between rapid ascent and relative price stability marked a critical feature of the rally. Silver's historic move did not occur in isolation. Beyond gold and silver, the rally extended across the broader precious metals complex. Platinum rose by more than 3%, reaching $2,143 per ounce, while palladium gained over 2% to trade near $1,883. Rhodium also advanced, increasing by approximately 2.65% to reach $10,350. These synchronized gains demonstrated that the market response was not confined to a single metal or supply narrative. Instead, capital flowed broadly into precious metals as a group, reflecting a unified reassessment of value and risk. The breadth of the rally suggested that investors were positioning across the complex rather than concentrating exposure in one asset. Such coordinated movement often accompanies shifts in macroeconomic expectations, where diversification within a sector becomes a priority. The gains in platinum, palladium, and rhodium reinforced the view that the precious metals market was experiencing a collective repricing, driven by shared catalysts rather than isolated fundamentals. This wider participation added weight to silver's move, situating it within a larger structural trend. One of the clearest indicators of silver's relative strength was the narrowing of the gold-to-silver ratio, which fell to 54.18. This shift reflected silver's outperformance relative to gold during the rally. Historically, changes in this ratio serve as a measure of how investors allocate capital between the two metals. A declining ratio indicates that silver is gaining value faster than gold, signaling increased confidence or urgency in silver-specific exposure. The compression of the ratio during this period highlighted the intensity of silver S advance and its ability to outperform even as gold reached record highs. This dynamic suggested that silver was not merely following gold upward, but asserting its own momentum within the market. The ratio's movement provided a quantitative framework for understanding the rally, translating price action into relative performance. It underscored that silver was assuming a more prominent role within the precious metals landscape, attracting attention not just for its absolute price, but for its comparative strength. At the core of the rally was a surge in investor demand for safe haven assets. Concerns surrounding the independence and actions of the U.S. Federal Reserve played a significant role in shaping market sentiment. Perceived political interference with monetary policy undermined confidence in traditional financial instruments, prompting investors to seek alternatives viewed as insulated from institutional risk. Precious metals, long associated with monetary stability and independence from policy decisions, benefited directly from this shift. As questions arose regarding the credibility and autonomy of central banking, demand for assets outside the conventional financial system intensified. This environment fostered a sense of urgency, where capital moved decisively rather than cautiously. The appeal of silver and gold as stores of value strengthened as investors reassessed the reliability of policy-driven markets. These concerns did not emerge in isolation, but interacted with existing anxieties, amplifying their impact on asset allocation decisions. The result was a rapid escalation in demand that translated directly into higher prices. The weakening of the dollar and treasury bonds further reinforced this environment. As confidence in monetary and fiscal stability eroded, traditional safe assets lost some of their appeal. Falling U.S. interest rates compounded this effect, reducing the opportunity cost of holding non-yielding assets like precious metals. At the same time, rising geopolitical tensions contributed to an atmosphere of uncertainty. Potential instability in regions such as Iran and Venezuela added another layer of risk to the global outlook. Together, these factors formed a unified backdrop that favored tangible assets over paper-based instruments. The convergence of monetary, political, and geopolitical pressures created conditions where precious metals became a focal point for defensive positioning. Each element reinforced the others, producing a feedback loop that intensified demand. In this context, silver's surge reflected not a single trigger, but the cumulative weight of multiple destabilizing forces acting simultaneously. Supply-side dynamics within the silver market added further pressure. Ongoing tightness in physical supply, combined with fears of U.S. tariffs, contributed to the rapid drawdown of warehouse inventories. As available stocks declined, concerns grew regarding the market's ability to meet rising demand. This imbalance between supply and demand heightened sensitivity to price movements, amplifying volatility and accelerating gains. The draining of inventories served as a tangible indicator that the rally was grounded in physical constraints, not solely financial speculation. Market participants responded to the perception of scarcity by securing exposure more aggressively, reinforcing upward momentum. These conditions transformed supply tightness from a background issue into a central driver of price behavior. The interaction between shrinking inventories and surging demand created a structural tension that pushed prices higher, even as volatility increased. Speculative activity also played a role, particularly in China, where deep-pocketed funds increased their exposure to commodities. This influx of capital added momentum to the rally, intensifying price movements and contributing to the rapid escalation observed across metals. The participation of large funds signaled confidence in the broader trend, while also introducing an element of speculative acceleration. Such activity often magnifies existing trends, pushing prices beyond levels justified by fundamentals alone. In this case, speculative demand interacted with supply constraints and macroeconomic uncertainty, creating a powerful combination. The result was a market characterized by heightened emotion and rapid repositioning, where price movements became both a cause and consequence of investor behavior. As prices surged, expectations surrounding the possibility of silver reaching $100 intensified. A significant majority believed such a level could be achieved within a short time frame, reflecting the optimism generated by the rally. However, alongside this enthusiasm came caution. The rally was described as largely emotion-driven, characterized as an overreaction rather than a purely rational repricing. This acknowledgement introduced the possibility of a corrective phase, where prices could pull back toward the high 70s or low 80s after the current surge. Such a pullback would not negate the broader bullish outlook, but would represent a recalibration following rapid gains. Despite this, the expectation of $100 silver remained intact before the bull run's conclusion. This dual perspective captured the tension at the heart of the market, powerful momentum driven by emotion and uncertainty, tempered by awareness of volatility and correction risk.